Hi everybody, Nick Colas from DataTrek here. Hope you're having a good day. This is our new video channel. We're going to try something new here for a while and put out some of our work in video form, see what you think, see if you like it. If it catches some traction, we'll obviously keep up with it. And the purpose of the videos are really just to give you a sense of how Jessica and I think about the market, think about the issues going on, and put some context around our daily work in perhaps a different format. So the stuff that we'll talk about in these videos is just as much sort of longer term thinking as what's going on in markets day to day that we cover a lot in the DataTrek morning briefing. If you like the videos, obviously, feel free to sign up for a trial at datatrekresearch.com. The topic I wanted to discuss today was kind of a simple format, which is 3 things that I've learned over 30 plus years of investing and working on Wall Street that I think might be of use to you. And I want to break it down in kind of a 3 bite-sized nuggets. The first one is a very simple one, but I think a lot of people still ignore, and that is you got to respect price momentum. It sounds super simple, but it is not. I learned this working for Steve Cohen at the old SAC as a PM and analyst, and it really stuck with me over the years. And it's very simple. It's a very simple rule. Never sell a new high, never buy a new low. And it sounds kind of childish in its simplicity, but it is absolutely important to understand why it works. And why it works is price momentum is a critical factor in how capital markets behave, both to the upside and the downside. It's especially true in growth stocks. If you look at the academic work on price momentum and other big factors in investing, you're going to find that growth and price momentum are 2 of the most predictive factors to future stock returns. So if a company is growing and its stock price is going up, it tends to continue to outperform. It shouldn't necessarily work that way, but it absolutely does. A simple example right now, literally from today, is the Qs, the NASDAQ 100 or the NASDAQ or big tech. Most of those names are making new 52-week highs. They're growth companies with price momentum. It's very hard to step in front of that train. I've seen a lot of people make this mistake over the years and think, oh my God, a stock is at a new high. It's not going to go up anymore. It's overextended. It's overvalued. By and large, that thinking is wrong. You got to wait for a pullback. You got to wait for those prices to stabilize before you either start thinking about lightening up or shorting the stock. So price momentum is the first lesson that I've learned and really has stuck with me the most of anything that I've seen in 30 plus years on Wall Street. The second one is a little bit of a longer term or behavioral kind of concept, and it's a prospect theory. It's the first idea from behavioral finance to win a Nobel Prize. Daniel Kahneman won it, and Amos Tversky, his partner who passed away before the Nobel was offered, contributed a lot to the work. And it's a very simple idea, but again, kind of counterintuitive. And it basically says prospective losses hurt us psychologically about twice as much as equivalent sized gains. So if you're worried about losing $100, you kind of have to hope that you are going to make $200 in order to have kind of an equal amount of psychological impact. I'll give you a simple example. Let's say I offer you a coin toss game, very straightforward, but I'm going to offer you $100 to not play the game at all, or I'll offer you a $300 prize if you guess the coin flip correctly. Now, the expected value of the game is obviously $150, 50-50 on 300. So you should take that, but a lot of people take the $100 sure thing. And why is that? Because they sort of fast forward their lives and think, if I had chosen the $100, then I wouldn't have to have guessed the game correctly. And if I lose the game, I'm going to feel pretty stupid for having given up the $100. So in practice, people need to have a coin toss for like a $400 win or loss to offset the losing of, say, $100. So it's a 2-to-1 ratio. And the reason I think it's important to investors is you really have to feel like your ideas have a 2-to-1 payoff ratio. So if you're thinking about a stock that's 100, you are going to really want to see 20% upside and only 10% downside. Otherwise, it's just very hard to stay in the position. So you have to have conviction. And conviction really stems from that 2-to-1 ratio. If you're thinking, okay, it's maybe got 15, 20 points of upside, but kind of an equivalent amount of downside, you're not going to stay with that position very long, whether it be as a long-term investor or as a trader. So prospect theory is, again, a really important idea to keep in mind as you go about thinking about new positions and new investment ideas. The last one is something that's a bit of an anomaly. And it basically says the market's never wrong, but the market's also always wrong, because obviously prices change every day. And this comes from efficient market theory, which I learned at Chicago in business school, from the folks who invented it, Gene Fama and the rest of that crew. And they were very clear to say, Efficient market theory doesn't mean that stocks are always perfectly priced, correctly priced. It says that there's no reliable way to figure out which ones are incorrectly priced. And the reason that's important is again, back to the prior point, you need high conviction ideas. Those are the ones that, in concert with your research, your thoughts, and then analyzing if your information is not in the market, give you an investment edge. And that's, again, a super critical point. I'll give you an example here. And it's one that I think people don't talk about enough. Over the last 10 years, the S&P 500 has compounded at 13% a year, which is a great return. Kind of a little bit above average, but a great return. The Russell's up 8% compounded over the last decade. Again, a solid return. Perhaps not as much as it should be for being small caps, but a solid return. Rest of world stocks are only up 4% on a compounded basis over the last 10 years. And you might look at that and say, that's got to be an anomaly, right? How can the rest of world be only half the Russell and a third of the S&P? They must be ready for a catch-up, and a lot of brokerage firms are talking about that. I look at it entirely differently. What those returns are telling us is that there's something fundamentally different about the U.S. economy and U.S. capitalism versus Europe or Japan or emerging markets. And it's very simple. U.S. companies are just better allocators of capital. They have global opportunities in many cases. Look at big tech, for example, or any big industrial company. They're well managed, and they have very strong competitive positions. More than anything, they focus on keeping returns high, where rest of world simply does not. And so I don't look at that spread in the last 10-year returns as any kind of anomaly that the market's got something wrong. Remember, the market's never wrong. What you have to do is understand what the market is saying. And what the market is saying is U.S. companies are just better. Their valuations are higher, and they should be. Their returns are higher over time, and they should be. And so that's one reason, probably the major reason, that at DataTrek we recommend being overweight U.S. stocks and really think long and hard about why you want to invest overseas. And you had better pick companies that are very good, at least as good as the average U.S. company, or those stocks are very likely to underperform. So those are the three basic ideas that I wanted to outline today. And just to summarize, respect price momentum, never short or sell a new high or buy a new low. Wait for prices to consolidate before establishing positions that are contrary to trend. The second is, remember that prospect theory says that losses weigh much more heavily on us than gains. So manage your emotions and manage your process around that fact. And then lastly, the market's never wrong. When it is, you have to really figure out what your edge is before taking an investment position in a particular idea, and our idea there is basically overweight U.S. stocks. So I hope those thoughts helped. We'll come back with ideas. If you have ideas for us to talk about, certainly leave them in the comments. Subscribe if you like this video, and we'll talk to you soon. Bye-bye.